Now that's a scary thought, wondering if your mortgage is legal. How would we know exactly if we as a home buyer did everything right, or we thought we were doing everything right, only to find out that we were bamboozled or we fell victim or prey to an unscrupulous mortgage lender? Let's take a closer look at mortgage fraud and what you can do about it. My name is Andrew Finney, and my passion is to help you make sense of real estate. If you need help finding a top agent near you, or if you simply want to drop me a line to say hello, my contact info is below. If you're new here, please go ahead and subscribe to this channel now and like this video. Thank you. All right, my friend, I know it can be very, very scary wondering if you had mortgage fraud, or if you're a perpetrator of mortgage fraud, then you do need to be very scared, because we do have the FBI in the United States, and the FBI is aggressively pursuing the issues of financial institution fraud, FIF for reference as an acronym, and mortgage fraud. Let's take a closer look at each of the things, including 9 common scenarios, including 9 common mortgage fraud schemes, so that you can better assess them and identify them. Share them around, because if we know what to look for, we won't fall prey to an unscrupulous practice. The first thing to know about is financial institution fraud, or simply an acronym, FIF. The FBI.gov website looks at financial institution fraud as a class of criminal schemes targeting traditional retail banks, credit unions, and other federally insured institutions. Many financial institution fraud schemes involve the compromise of a customer's account or personal identifying information when identities are stolen. Both the financial institution and customers are considered victims. So you might be wondering, exactly how would this happen with the financial institution fraud? Well, it could be internal players within an actual credit union or bank that have access to your information, or it could be from an external impact. Remember that hackers are a very real threat in today's day and age with advancement in technology. While it makes our life much more convenient to have applications on our phone and to have mobile banking, it also leads to greater security risk and the need for tightening up the security of what we do with our money. What could happen is you could get a hacker that hacked into your email, got your financial data, and started hacking away at you, and now has compromised you and or your bank. This constitutes a financial institution fraud. The most common types of financial institution fraud are stolen or counterfeit checks, account holder impersonation, access device fraud, misuse, unauthorized use of debit cards, credit card scams, and email hacking leading to loss. Now, those are the kind that we as a consumer are most likely to see. The FBI said the most common types of internal financial institution fraud consist of embezzlement or misapplication of funds. The real threat here is that if it's not caught and if it's not identified, it could lead to the collapse of a federally insured financial institution. We don't want that. That's why the FBI aggressively pursues these crimes. The second thing is the one that we probably are the most familiar with, or have at least heard about, called mortgage fraud. Mortgage fraud is actually a subcategory of the financial institution fraud. The way the FBI defines this is a crime characterized by some type of material misstatement, misrepresentation, or omission in relation to a mortgage loan, which then is relied upon by a lender. A lie that influences a bank's decision about whether, for example, to approve a loan, accept a reduced payoff amount, or agree to certain repayment terms is mortgage fraud. It is important to note there is more than just the FBI that investigates cases of mortgage fraud, especially in the wake of the 2008 housing collapse, and they are specifically watching for people that would prey on distressed homeowners. There are 2 distinct categories of mortgage fraud. One is called fraud for profit, and one is called fraud for housing. Fraud for profit are oftentimes committed by industry insiders using their specialized knowledge or authority to commit or facilitate the fraud. Current investigations and widespread reporting indicate a high percentage of mortgage fraud involves collusion by industry insiders such as bank officers, appraisers, mortgage brokers, attorneys, and loan originators, and any other professionals engaged in the industry. Fraud for profit aims not to secure housing, but rather to misuse the mortgage lending process to steal cash and equity from lenders and homeowners. The FBI prioritizes fraud for profit cases. The second type is fraud for housing. With fraud for housing, it is typically represented by illegal actions taken by a borrower, in other words, a homeowner that has received or is in the process of trying to receive a mortgage loan. The borrower is motivated to acquire or maintain ownership of a house. The borrower in this case could, for example, misrepresent income and asset information on a loan application, or entice an appraiser to manipulate the property property's appraised value. It is important to note that the FBI throws a wide net out there to catch as many cases like this as possible to protect everybody in the United States from financial institution fraud and mortgage fraud. This is a good thing. So let's thank the FBI for their hard services here. So the third thing is learning how to recognize mortgage fraud schemes. There are 9 common types that happen. What I'm going to do is I'm going to have this popped up on the screen so that you can read along as I'm going through it. And I want you to think through it clearly. And if you need to take notes, that's why we're putting it on the screen, to make it easy to understand for you and to share it around with everyone that you know. The first one is foreclosure rescue schemes. With a foreclosure rescue scheme, it is a perpetrator that will identify a homeowner that is in a foreclosure or at risk of defaulting on their mortgage loan and then mislead them into believing that their mortgage and their home can be saved by transferring the deed or putting the property in the name of an investor. What happens here is the perpetrator will profit by selling the property to an investor or a straw borrower, creating equity using a fraudulent appraisal and stealing the seller proceeds or fees paid by the homeowners. The homeowners are sometimes told they can pay rent for at least a year and repurchase the property once their credit has been reestablished. However, in reality, these perpetrators fail to make the mortgage payments, and usually the property does end up going into the foreclosure. This is particularly despicable and inexcusable. Please open your eyes and please make sure that if you get any solicitations from someone saying they can rescue from a foreclosure process, that you have that conversation directly with your bank and not outside entities. The second common mortgage fraud is loan modification schemes. A loan modification scheme is kind of similar to a foreclosure rescue scam. These types of schemes involve perpetrators purporting to assist homeowners who are delinquent in their mortgage payments and are on the verge of losing their home by offering to renegotiate the terms of the homeowner's loan with the lender. The scammers, however, demand very large fees up front and often negotiate unfavorable terms for the clients or do not negotiate at all. Usually, the homeowners ultimately lose their home. So you see, with both of the first 2 types of mortgage fraud, from the foreclosure rescue scheme to the loan modification scheme, what was the end result of both? The homeowner lost their home. It's best to have a conversation with the appropriate professionals and know whom you're dealing with. Be careful what you read and see. Not everything can be believed. The third type of mortgage fraud is an illegal property flipping. This is when a property is purchased, falsely appraised at a higher value, and then quickly sold. What makes property flipping illegal is the fraudulent appraisal information or false information provided during the transaction. Typically, these schemes will involve one or more of the following attributes: a fraudulent appraisal, falsified loan documentation, inflated buyer income, or kickbacks to the buyers, investors, property, loan brokers, appraisers, and even the title company employees themselves. That being said, is flipping property in the United States illegal? No, it's not an illegal activity. Notice what we said a moment ago about what constitutes illegal property flipping. And if you know someone that might be going down that path, let them know to pull back before it's too late. The fourth type of mortgage fraud is a builder bailout or a condo conversion. Builders that are facing rising inventory and declining demand for newly constructed homes will employ what are called bailout schemes to offset their losses. In this case, a builder will find buyers to obtain a loan for the properties, who then allow the properties to go into foreclosure. In the condo conversion scheme, an apartment complex may be purchased by a developer during the housing boom and then are converted into condos, and in a declining real estate market, the developer will often have too many of those condos available, so the unscrupulous developer would recruit straw buyers in that case with cashback incentives, inflate the value of the condo to obtain a higher and larger sales price at closing. In addition to failing to disclose to the cashback incentives to a borrower's lender, the straw buyer's income and asset information are often inflated in order for them to qualify for the properties that they otherwise would not get whenever a mortgage loan officer verified their income, assets, credit, and employment situation. The fifth common mortgage scheme is called equity skimming. Let's take a look. With equity skimming, an investor may use a straw buyer, false income documents, and false credit reports to obtain a mortgage loan in the straw buyer's name. Subsequent to the closing, the straw buyer signs the property over to an investor in a quitclaim deed, which relinquishes all the rights to a property and provides no guarantee to title. The investor does not make any mortgage payments and rents the property until foreclosure takes place several several months later. The sixth type of mortgage fraud is called a silent second. In a silent second, the buyer of the property borrows the down payment from the seller themselves through the issuance of a non-disclosed second mortgage. The primary lender believes the borrower has invested his or her own money in the down payment when in fact it's borrowed from the seller. The second mortgage may not be recorded to further conceal its status from the primary lender. So the question might arise here, is seller financing a legal practice? Seller financing is a legal practice so long as it's disclosed to the borrower's lender themselves. They need to know about this. What makes it illegal is when it's not disclosed to the buyer's lender and they're trying to keep it under the table hush hush. If caught, you could face penalties and fines, if not imprisonment, through the FBI. The seventh type of common mortgage fraud is particularly despicable because it preys on the elderly. It's called a home equity conversion mortgage. Let's better understand this, and if somebody you know is over the age of 60, please get this information to them so that they know how to make a well-informed decision that's right for them. Essentially, a home equity conversion mortgage is also an acronym HECM. A home equity conversion mortgage is a type of reverse mortgage loan product insured by the Federal Housing Administration to borrowers who are 62 years or older. They own their property or have a small remaining mortgage balance. They occupy the property as their primary residence and participate in a home equity conversion mortgage counseling. It provides homeowners access to equity in their homes, usually in the form of a lump sum payment. So now what happens here is unscrupulous perpetrators taking advantage of the home equity conversion mortgage program will recruit seniors through local churches, investment seminars, television, radio, billboard, and even mailer advertisements. The scammers then obtain a home equity conversion mortgage in the name of the recruited homeowner to convert the equity in their homes into cash. Then the scammers will keep the cash and pay a fee to the senior citizen or take the full amount unbeknownst to the senior citizen. No loan payment or repayment is required until the borrower no longer uses the house as a primary residence. As such, in this scheme, appraisals on the home are vastly inflated and the lender does not detect the fraud until the homeowner dies and the true value of the property is discovered. Please make sure that your loved ones do not fall prey to any of the mortgage frauds, but especially those that are over 60 years old. The older we become in life, the harder it is for us to bounce back from hard knock things that happen to us. Let's make sure we shine the light on those that would prefer to hide in the dark to expose them for what they are. The eighth type of common mortgage fraud is a commercial real estate loan. That's not to say that commercial real estate loan is all illegal. It's what happens underneath each of these mortgage frauds that make them illegal. In the case of a commercial real estate loan, it's when the owner of a distressed commercial real estate or those acting on their behalf obtain financing by manipulating the property's appraised value. The way this would go is a bogus lease would be put into place to create or exaggerate the building's profitability, thus inflating the value as determined by using what's called an income method for the property's valuation. Fraudulent appraisals trick lenders into extending loans to the owner. As the cash flows are actually lower than stated, the borrower then struggles to maintain the property and repairs are often neglected. By the time the commercial loans are in default, the lender has often left with a dilapidated or difficult to rent commercial property. Many of the methods of committing mortgage fraud that are found in residential real estate are also present in commercial loan frauds. And the ninth type of common mortgage fraud are what are called heir loans. An heir loan is essentially a non-existent property loan where there is usually no collateral. Heir loans involve brokers who invent borrowers and properties, establish accounts for payments, and maintain custodial accounts for escrows. They may establish an office with a bank of telephones, each one used as the fake employer, appraiser, credit agency, etc., to fraudulently deceive creditors who attempt to verify the information on their loan application. It's important to note here to keep our eyes open. We are always stronger and better together than we are not. That's why I wanted to make this video and get this information to you so that you can share it around as you see fit and you know that the FBI has your back and is there to protect you. If you suspect that you have fallen victim to any of the mortgage fraud, please visit the FBI.gov website. All right, my friend, I really hope none of you ever experience mortgage fraud or financial institution fraud, but now hopefully you're better aware of what it is and you can take it and be more knowledgeable and share it with everyone that you care about so that they don't fall victim to financial institution or mortgage fraud. So now let's take a look at the top 5 real estate scams and exposing 6 common mortgage scams just to make sure that these things never happen to you. Looking forward to our next conversation. We'll see you in a few.